This is literally the most important video that I have ever made, and I think that you should drop everything you're doing and watch this video. Obviously, don't park your car on the side of the road, but this is just insane. Jeffrey Gundlach says what's happening right now could cause the next financial crisis. And honestly, what he says makes a lot of sense. Too much sense. Scary amounts of sense. Especially with what the Fed said today. I think he's hitting it right on the head. And I really don't want to cause fear in this video. I'm bullish on Tesla. I'm bullish on certain sectors of the markets for 2024. A lot of the markets have already priced in really, really bad things for 2024. But if this specific scenario were to happen, which is too high of a likelihood to ignore, we could have a big problem on our hands. Now, me and Jeffrey Gundlach, we disagree on some of the timing of how these events might take place. I think it might happen a little bit later down the line, but I don't think he's wrong. Honestly, I don't think he's wrong at all. And that's what's scary about this. And I think it makes sense after what we've seen lately with the bonds and what we just heard from the Fed. So I'm very excited to bring you guys this information. I really don't think you'll find another video like this on YouTube that's breaking this down. By the end of it, you're probably going to be an expert on bond stock relationships, the treasury, all of that. Don't get too lost in the sauce. It's not that complicated. We will break it all down, and hopefully this information helps you make more money. At the end of this video, I'm going to tell you guys what I am doing, what my timeline is, what kind of stocks I'm buying. Am I buying Tesla right now? Short answer is yes, but I want to keep a lot of cash on the sidelines. So I'm going to let you guys know exactly what I think about this situation. Let's just go ahead and jump straight into it with what Jeffrey Gundlach just said. This is a small clip, I think the most important part, but we're going to show you guys the part where he's talking about a whole financial crisis because of this situation.
Lower equity prices. He actually brought that into the mix today as being a thing that could influence their future rate decisions, that if something happened in the stock market, that could be a powerful influence for the Fed. What's your take on that?
Well, what's new here? I mean, that's always the case. Remember 2018, where we had that bear market in the fourth quarter of 2018 because the Fed said that they were on autopilot for raising rates and doing quantitative tightening, and the stock market dropped 20% in like four or 5 weeks. The junk bond market seized up. There was no issuance for weeks on end, and suddenly the Fed started cutting rates and abandoned all of their rhetoric. So I believe deeply that when the recession comes, you're going to see a bond rally. It may be accompanied with a stock rally initially, but they're going to reverse because of the policies. And then we'll see what happens when the stock market starts to drop in earnest with what would be surprisingly potentially a weak economy with rising bond yields after their initial decline.
Now, to someone that does not understand equities and bonds and the Fed and how the Fed kind of influences long duration treasuries but doesn't control them, that may have made 0 sense, but I promise you that was a scary thing that he just said. In kind of the easiest way to explain this, imagine if treasury yields rise so much and they stay 5% around there for the 10-year treasury. Imagine if stocks start to fall. Imagine if the economy starts to head into a recession, and then the Fed's like, hey, well, we want to stimulate the economy because inflation's basically gone and we don't want to have a recession. The Fed gives you a rate cut, 25 basis points. The bond market, he's saying, might initially come down, the yields, but due to the Treasury selling massive quantities of bonds when nobody wants to own them in the first place, yields are still going higher on your long-term treasuries. Your long-term treasuries are what really affects the economy. It's not the Fed raising rates. It's the bond market. That's why the Fed's freaking out, because long-term, long-duration yields are starting to rise. That's the first time the Fed is actually, or that's why this is the first time the Fed has acknowledged lower stock prices could affect Fed policy. We're going to get into all of this, everything you need to know. I promise you it's not that complicated. By the end of this video, you might be an expert in bond and stock correlation, and I promise you it will help you make money over your investment lifetime. There are specifically two things the Fed said that I think you need to pay very close attention to as an equity investor. Here's the first one. Quote, "It does not appear that an expectation of higher Fed policy rates is causing higher, longer-term rates." The Fed, let me put this into English, is saying we are not controlling long-term yields. And they're not. Let's be honest. Since May, the Fed has raised rates twice. Once in May, once in July. Take a look at where the 10-year yield was trading back in May. Okay, hopefully we'll put it into some perspective. In the beginning of May, the 10-year Treasury yield was about 5.5%. It was as low as 5%, 3.5%. It was as low as 3.35%. The 10-year Treasury yield just recently hit 5%. That means that your 10-year Treasury yield has went up 1.5 to 1.7%, depending on what point you're looking at. When the Fed has raised rates twice, that means the 10-year Treasury yield has went up over 1% on top of what the Fed has done. The Fed's telling you, just read between the lines, it's more so the investors' assessment of government risk and the exuberant amount of Treasury auctions that we are seeing that is forcing your Treasury yields to really be disconnected from Fed policy. The second thing that Powell said, in conjunction with the first, is very important, and I think is preconditioning the markets to a certain extent of what is coming next. Quote, "Tighter financial conditions from higher long-term rates, stronger dollar, lower stocks could matter for future rate conditions." That's just insane. This is the first time we have heard the Fed outright say really anything about the stock market. The Fed, if they were ever asked about stocks, said, yeah, we really don't care. We don't even pay attention to that. But imagine a situation where longer-term treasuries, 10-year Treasury yields, are doing their own thing because the Treasury's spending money like they're drunk. The government's doing their own thing. They're all drunken sailors just cruising in the sea, doing whatever they're doing. Well, the Fed has no control over that. But imagine if your dollar strengthened, because that's usually what happens when Treasury yields rise. I'll show you that chart here in just a second. But imagine if stocks also were going through a decline. That would be way too much pressure on the economy. The dollar rising is pressure. Basically, the most pressure you can get on our markets is when long-term treasuries rise, 10, 20, 30-year treasuries, and you add on top of that stocks, that could force the Fed to give you massive rate cuts. Massive rate cuts. Jeffrey Gundlach could be correct here, but what he says specifically is kind of a scary outcome. Towards the end of this clip, it wouldn't be pretty for stocks or the economy if this happened.
I don't know, Josh. I mean, there's some logic to that. I think that the wealthy people, they have savings. They have wealth by definition. And so them getting a higher interest rate of 6% instead of 2%, I'm not really sure that motivates spending exactly. I think it just makes them wealthier. So I don't really know about that. I just think that all of those unusual things that happen that you correctly point out, I think when you drop $4.5 trillion of free money into an economy, one should not be careful about predicting that's going to have outsized consequences. So what I think everybody missed here is what we had initially with all that stimulus was a massive boom in consumption of durables. and that sort of the manufacturing part of the economy. And then what people missed is it then turned into a services economy because there was all this pent-up demand for services and travel and leisure and all that stuff. And I feel like that's wearing off at this point in time. And so I'm not really sure that those conditions are going to endure much longer. And I say higher for longer. I'm going to go back to my number one point that I started this segment on. And that is higher for longer means we have a massive interest expense problem in this country that is going to be, I believe, the next financial crisis. And so that's what I'm more focused on rather than some Scrooge McDuck having more money in his vault.
What about the idea of cash being king? I've had people come on, the network this week and suggest that is actually the best place to be. That's where the lowest amount of risk is right now. What amount of cash would you have in a portfolio now?
I don't like cash because I think that your interest rate, which is very attractive presently, may decline quite substantially next year. So I would rather be in something that's about 2 to 3 years. So at least you're getting that yield that I talked about, around 8%. At least you're going to get that for more than 6 months. T-bill and chill, you can buy the 6-month T-bill and get 5.5 and spend that way for a long time now. The rate is no longer going higher. It's now starting to potentially decline. So I don't think you want to be in cash. The shape of the yield curve suggests that the 2024 will see the Fed cut rates by about 50 or maybe 50 basis points or maybe 5/8%. That's the one thing that I think will not happen. I think that either there are going to be rates will stay high for longer, which is not my base case, but I acknowledge that's a possibility. But if the economy rolls over as I expect, the Fed is not going to cut rates 50 basis points. They're going to cut rates 200 basis points. And that's what's wrong with the cash strategy.
The other thing I heard the chair say today that I frankly don't recall him saying, certainly not at a meeting, was when he was addressing the idea of what the backup in rates has done, where financial conditions have gone. He said they're attentive to all of that. He did mention a stronger dollar being an influence on future rate decisions. And you know what else he said, Jeffrey, which sort of struck me at that moment? Lower equity prices. He actually brought that into the mix today as being a thing that could influence their future rate decisions, that if something happened in the stock market, that could be a powerful influence for the Fed. What's your take on that?
Well, what's new here? I mean, that's always the case. Remember 2018, where we had that bear market in the fourth quarter of 2018 because the Fed said that they were on autopilot for raising rates and doing quantitative tightening, and the stock market dropped 20% in like 4 or 5 weeks. The junk bond market seized up. There was no issuance for weeks on end, and suddenly the Fed started cutting rates and abandoned all of their rhetoric. So I believe deeply that when the recession comes, you're going to see a bond rally. It may be accompanied with a stock rally initially, but they're going to reverse because of the policies. And then we'll see what happens when the stock market starts to drop in earnest with what would be surprisingly potentially a weak economy with rising bond yields after their initial decline.
So he said, once the economic pain starts to happen, once you start to get investors pricing in rate cuts from the Fed, a recession, he thinks some point in early 2024, it could be late 2024. You really don't know. That part of it is hard to say. But he's basically saying, once you start to see a pullback in yields and in stocks, yields are probably going to shoot right back up again because the Treasury is spending money like they are drunk, and it's a supply and demand dynamic. I'm just going to read through the lines to you for that one. The government's riskier today than they were before. And the Fed right now has no control on the long-term yields, no matter what they're doing with their policy. He's saying in English that even if the Fed cuts rates and we go into a recession, the bond market might not react to a small rate cut. He's saying a 25 basis point rate cut, a 50 basis point rate cut might not bring down Treasury yields. Imagine in a situation where all of this tightening, these higher yields, 8% mortgage rates, 30-plus year high delinquency car notes, comes back to hit the economy hard. And then the Fed wants to accommodate the economy because Fed funds rates are at 5.5%. He's saying if you were to take Fed funds rates from 5.5% to 5% or even 4.5%, your 10, 20, 30-year treasuries might not even react to it. So you could be in a situation where the Fed is literally forced to give you 200 basis points, 2% rate cuts, even potentially more than that, just because the market's not responding to the Fed. That's what he's saying. That could be probably your worst case scenario for the economy and for equity markets. Imagine a recession where your 10-year treasury yields stay stubbornly high. You don't go back to 1% like you were during the Rona. Maybe you stay at 3.5% to 4%. That's okay if the economy is doing well. If it is not, then you get into a big problem. If you're in stocks, I think longer term, right, after maybe a 6-month period, 3-month period, 2-month period, some decent amount of time after that initial pullback, all of that stimulus would be good for stocks, right? The Fed would have to go from quantitative tightening to quantitative easing at the bare minimum to bring down the bond market and probably cut rates at this point. Again, it does depend on how far the, treasury market gets disconnected from Fed policy. Imagine it like this. If 10-year treasury yields were to continue to rise to like 5.5%, and the Fed does nothing else, you're going to get even more disconnected to where the Fed funds rate currently is. And your long duration, shouldn't be as affected as like your 2-year. Your 2-year bonds would fall with Fed policy. But if your 5-year bonds do not react, you can get an asset class that is disconnected from reality. That's a scary situation. That's a situation we have never been in before. But when you think about things logically, we've never been at a deficit like we are now. We've never seen devaluation of the dollar like we have right now. We've never seen so many countries that do not want to own U.S. debt. That's what's pushing the treasury yields higher. It's because people don't want to own U.S. debt. Why would they? We're issuing more debt like every week or two for $100 billion here, $50 billion here. There's going to be more supply that hits the markets. We're looking at raising, I believe it's like $2 trillion of debt next year. Over a $1 trillion. I'll have to get the exact number for you guys. But that is counteracting what the Fed is trying to do. That's really the bottom line. And if the Fed is not in a position to lower rates and lower treasury yields, which dictate your actual yields, keep this in mind. The Fed raising rates affects bond yields. So your mortgage rate, if you're a mortgage broker, you know this. If you're anyone in real estate agents know this. Your home loan is based on the 10-year treasury. They usually go about 2.5% to 3% higher than your 10-year treasury yield. So that's why when 10-year treasury yields are 5%, you're getting an 8% mortgage with good credit. Well, just imagine this scenario that we're playing out. So I think Fed Powell today really tried to condition the markets in a way, maybe not to boost inflation expectations by saying, yeah, we're thinking about cutting. I mean, that might boost inflation expectations. That might be counterproductive to inflation. He still was bearish and hawkish enough, but he opened that door, especially with those two statements, to say, hey, if stocks fall, if the dollar continues to rise, if treasury yields continue higher, that's going to change the course of Fed policy. He opened the door for a U-turn with those two specific statements. I think that was very important that I don't know if the markets are catching on to as of right now. Now, like I said previously, TLT is this chart. The dollar is this chart. They should, in theory, invert themselves, right? If you have higher yields, then dollars should be a little bit more scarce to come by, right? As you restrict the economy. So the dollar should go higher. as Fed funds rates go higher, as treasury yields go higher. This hurts your multinationals, and this is kind of the Rona, right? Pre-pandemic, you were kind of stable with the dollar. There just wasn't a whole lot happening as far as, the flow of money, the economy, right? Things were kind of just stagnant, kind of growing, doing their thing. So that's why the dollar really didn't move that much. Now, Rona, right? Dollar fell, you rose, and then you stayed high and you trended downwards. Because investors were like, easy money, dollars are everywhere. Well, dollars are going to be cheaper, right? Your foreign conversion is going to be cheaper. Fed starts to raise rates, dollar goes parabolic, you've baselined out, and the dollar is increasing again. If the dollar starts to get back to where you were back in October, let me tell you right now, the Fed would be cutting rates at that point. That would be way too restrictive on the economy. That hurts your multinationals. That hurts companies that do business overseas. Like a Apple, like a Tesla, like a Nvidia, basically any large company you can think of, Google, Microsoft, right? So on and so forth, Amazon, that does any business in foreign currencies, it hurts those companies, which would put pressure on those company earnings, which would put pressure on laying off employees trying to keep margins. So I think this was very important. Hopefully this makes some sense. If it does not, let me know down below in the comment section. We will try to cover this maybe a little cleaner in another video. I think this was probably the best way to explain it. And again, just to summarize, the Treasury, the government, is spending so much money, taking on so much debt, that treasuries are not responding to Fed policy. That's why Treasury yields have went like this, and Fed policy is like this. It's not really doing much. Yet Treasury yields continue to rise. Fed Powell said they are basically disconnected. The Fed is not why treasuries continue to rise. It's not at a breaking point right now, but 5.5%, you start to creep towards 6%, and you're in for a problem. If you couple that with a declining stock market, which that's been the trend, right? Yields going higher, stocks going lower. That has literally been the trend of the second half of 2023, or really the last couple of months. Fed Powell saying if that happens, the Fed would be forced to start cutting rates. Jeffrey Gundlach is saying small rate cuts wouldn't even help the situation. Stocks might get a temporary boost, bonds might get a temporary fall in yields, but it will not be enough to change the course of a recession in the economy. So what is my ultimate outlook? And then you get into a really nasty situation with a lot of different variables that could ultimately play out. And that's just a dirty area that I don't even want to get into right now because we're far from that. I'll keep you posted if that's the direction we start to move into. But as of right now, we're not there yet. The lower treasury yields go in the meantime. Great news. But how am I looking to invest my money after this latest Fed meeting? It's very simple. I'm going to be very selective with the companies I am investing in. A Tesla, some things that will benefit from rates going lower. That's where I want to put my money, some of my money. Now with Tesla, it's a fine line. Rates coming down, treasuries coming down, eventually Fed funds rates. That's great for Tesla as long as you're not in a deep recession. So if you think we're going into a deep recession, stay far away from Tesla right now. Stay far away from any company that is interest rate sensitive. Hell, stay far away from the markets in general. Not financial advice. I don't think we're going to go into a crazy deep recession. I don't think that debt bubble is finally bursting. 10, 15, 20 years from now, that will happen at some point. And hopefully we'll keep you posted. Hopefully you guys are still, on watching the channel by then. But that's a topic for down the line. I don't think we're there right now. So I think Tesla is a pretty good place to be putting your money. Other than that, I mean, it's hard to really say. I'm not selling anything. I want to be fully invested right now, but I want to save as much cash as possible. So ultimately, when that scenario does arise, which, one way or another, recession probably coming, I want to be in the best position possible to load up as much as possible. Because if Jeffrey Gundlach is correct, then rates are going way lower, like way, way lower at some point in 2024. And I gotta say, I kind of agree with him on the whole logic that the Fed is not controlling the bonds, that the bonds might not react if as much as the Fed would like if they did small rate cuts. The Fed would have to give you some big rate cuts to move the bonds, considering how much money the Treasury is issuing. The supply demand dynamic is way out of whack. Nobody wants to own treasuries, yet the Treasury is raising more, capital than ever. They're selling more bonds than ever at a time where nobody wants to own the bonds. This potentially not a pretty situation. Hopefully you guys like this video. Hopefully you guys like the honesty of this video. This one is just one I had to get out to you guys. I know this is probably not going to be liked. It's probably not going to get a lot of views, but hopefully it does help you guys make some money. Ultimately, that's what this channel is all about. Hit the like button if you guys like this open, honest, transparent take, and just an insight on what I plan to be doing right now. Subscribe to the channel if you guys have not done so already. Let me know what you guys think down below in the comment section as well. I am totally open to opinions. This is obviously not a guarantee. I would say this is a higher likelihood than I would like, maybe 50% of a chance, unless the Treasury were to just stop issuing bonds. They're probably not going to react to Fed policy. That is a great point that I have not heard anyone say before. So hopefully you guys heard it from this channel or Jeffrey Gunlock. Nonetheless, guys, I could ramble on and on about this situation. I think it is fascinatingly accurate in this current state of where we are. So look out below if we do start to see recessionary data coming in, and then we're forced with the proposition of the Fed cutting rates. It's not going to be stimulative enough. I guess that's a good take on this situation. So thank you guys for watching. My name is Michael Tyler. If you guys would like to come trade with us live in real time, link down below in the description of this video. Could be some interesting times ahead. So I'd love to see you over there. Come join us. You guys enjoy the rest of your day or night, and I will see you in the next one.